again, I said it last week, I'll go out on a limb and predict my equivalent November fall predictions. Last fall, it was that the markets were going to poop the bed. My prediction now is that I think the markets are bottoming and consolidating.
Yep, 100%.
And this is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of like tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. I'm actually pretty starting to get a little constructive here. I think that the investments that one makes in this period will probably be the best for many, many years to come, because they'll have the most asymmetric upside. And that was true in 2008 and 9 and 10. It was true in 2002, 3 and 4. You're talking incredible companies just in those two periods. Think about this: Atlassian, Tesla,
Uber, Google,
Airbnb, Uber, Instagram, WhatsApp, incredible businesses that have created tremendous value. And so there are businesses that have been invested in for the first time in 2022 and will be invested in for the first time in 2023 and 24, which will be the leading winners of this next phase and this next leg up. And so the real opportunity is to find out who those companies are and get behind them. And here's what I just want to call out for you guys. What's incredible is that other than the 1 in 83, so this is sort of like, that last big one, what we've seen is that the stock market has a tendency to immediately go to the conclusion very early on in a rate hiking cycle. And now, why is that important for normal folks listening to this thing? Well, the reason why that's important is right now we're in month 7 of a cycle. We obviously don't know how long it's going to be, but the odds are improving every day that we're near the end versus the beginning. Because again, if you're thinking about when to, buy equities, for example, this is a really instructive guide, because what it tells you is the closer we get to the end, or more importantly, the closer we psychologically know that the end is coming, we start buying. And that's just a broad-based statement that has been true. So, what you see right now, I think, is really interesting, which is that despite all the bad information, oh my gosh, the Nord Stream pipeline blew up. Could it have been sabotage? Was it the CIA? Was it the Russians? Oh my gosh, big tech is slowing spending and firing people.
China's in a coup. I don't know if you saw that rumor. Yeah.
Or how about something more benign? The US, US yuan is really trading in a crazy way. The US euro is trading in a crazy way. The US pound is going crazy. Yeah. Despite all of that, every time we trade down, the market consolidates very quickly. So I think we're forming a bottom. I do think that Stan is right. We are going to see a hard landing recession. Something will break in 2023. I hope it doesn't. I hope it doesn't affect a lot of normal people, but it's likely. But at the same time,
what do we define hard landing as?
So I'll tell you in a second. But at the same time, I think what's happening is in the equity and financial markets, we are consolidating a bottom because we're seeing through to that end state. And this is where cheap equity gets bought. So why is there a reason to sell now? I think a lot of the people that are selling, the smart money sellers that I talk to, are essentially right now selling to book in capital losses to offset other capital gains from this year, a term that's called tax loss harvesting. And so if you have gains through this year, which some of us do, this is the great moment to just sell the losers, to book the loss, to net it out so that you can minimize your taxes for next year. That's probably, I think, where we are at. And I think that's why there's still consolidated buying. You're going to see unemployment get to an awkward and uncomfortable number. 5-6%, I think, could be something that we see. And I think you're going to see a lot more companies pull way back on their spend because demand is going to really modulate. What happens to all the people in the United States that are on ARM mortgages, right? Adjustable rate mortgages. When those things reset, they're going to reset 200-300 basis points higher. Their monthly payments are going to go nuclear.
Oh, it's already happened, Chamath. I literally had a family member call me about this, and they were like, "What do I do?"
So in the UK, in the UK, 40% of all mortgage dollars are interest-only ARMs that will reset in January to around 4%. 40%. Can you imagine how upside down the UK economy is going to be when people have to spend 3 and 4 times more to keep their home?
And then people have to go to work.
If you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply-demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, and it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business. It's yet another indication to me that I think, broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol is being taken away, people are hanging around with a little bit, lights are coming on, they're like, I've been here a little too long. And I think that that's a very healthy process for an economy.